Question 1. Analysis of a situation where a registered broker-dealer in New York anticipates a significant capital withdrawal by a key investor that could reduce the firm's net capital below the minimum requirements within the next 30 days. What is the most appropriate regulatory notification action for the firm's financial and operations principal? Option A. Delay notification to FINRA until after the capital withdrawal has been completed and the firm's financial statements are updated. Option B. Inform only the firm's internal audit department about the impending capital withdrawal and its potential consequences. Option C. Proceed with the capital withdrawal and only notify FINRA if net capital falls below the minimum requirement after the withdrawal. Option D. Immediately notify FINRA of the anticipated capital withdrawal and its potential impact on net capital. The correct answer is D. Immediately notify FINRA of the anticipated capital withdrawal and its potential impact on net capital. Explanation. Analysis of this scenario reveals a significant professional challenge stemming from the tension between a firm's immediate financial needs and its regulatory obligations. The principal must navigate a situation where a substantial capital withdrawal, if not properly managed and disclosed, could trigger regulatory scrutiny and potentially jeopardize the firm's financial stability and its ability to meet customer obligations. The requirement for timely and accurate notification is paramount to maintaining market integrity and investor confidence. The correct approach involves immediately notifying the Financial Industry Regulatory Authority, FINRA, of the proposed capital withdrawal. This action is correct because FINRA Rule 17A11B mandates that member firms report any event that reduces their net capital below specified thresholds or that is reasonably anticipated to do so within a certain time frame. By proactively informing FINRA, the firm demonstrates transparency and allows the regulator to assess the situation and provide guidance or take necessary actions to protect investors. This aligns with the ethical duty of a principal to uphold the integrity of the securities markets and to act in the best interests of the firm's customers. An incorrect approach would be to proceed with the capital withdrawal without any notification, hoping that the firm's net capital remains above the minimum requirements. This is professionally unacceptable because it violates FINRA Rule 17A11B by failing to report a material event that could impact the firm's capital position. Ethically, it represents a lack of transparency and a disregard for regulatory oversight, potentially exposing the firm and its customers to undue risk. Another incorrect approach would be to delay notification until after the withdrawal has occurred and the firm's capital has fallen below the required minimum. This is professionally unacceptable as it constitutes a late filing and a failure to provide FINRA with advance warning, thereby hindering the regulator's ability to intervene proactively. It suggests an attempt to circumvent reporting requirements and can lead to more severe regulatory consequences. Finally, an incorrect approach would be to only inform the firm's internal audit department about the withdrawal. While internal reporting is important, it does not satisfy the external regulatory notification requirements. This is professionally unacceptable because it fails to fulfill the firm's legal obligation to report material capital events to FINRA, leaving the regulator unaware of a potentially significant risk to the firm's financial health. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves understanding the firm's financial position, identifying potential triggers for regulatory notification, and acting proactively to disclose material events to the appropriate regulatory bodies. When in doubt, seeking guidance from legal counsel or compliance departments is crucial to ensure adherence to all applicable rules and regulations. Question 2. The review process indicates that a FINRA member firm in California has recently appointed a new chief compliance officer. However, the firm's contact information on file with FINRA still lists the previous individual. What is the most appropriate and compliant course of action for the firm's principal to take? Option A. Inform the firm's internal audit department about the change, but refrain from updating FINRA until further notice. Option B. Immediately initiate the process to update the chief compliance officer's contact information with FINRA through the web CRD system. Option C. Assume the previous contact person's information is sufficient for a transitional period while the new CCO settles in. Option D. Delay updating the information until the firm's next scheduled annual filing with FINRA. The correct answer is B. Immediately initiate the process to update the Chief Compliance Officer's contact information with FINRA through the web CRD system. Explanation. The review process indicates a potential lapse in a FINRA member firm's compliance with essential filing and contact information requirements, specifically concerning the accuracy and timeliness of updating key personnel information with FINRA. This scenario is professionally challenging because it requires the firm's principal to balance operational efficiency with strict regulatory adherence. Failure to maintain accurate and current information can lead to significant regulatory scrutiny, fines, and even disciplinary actions, impacting the firm's reputation and operational capacity. The principal must make a swift and informed decision to rectify the situation while ensuring future compliance. The best professional approach involves immediately initiating the process to update the contact information for the newly appointed Chief Compliance Officer with FINRA through the appropriate channels, such as FINRA Web CRD system. This proactive and direct engagement with the regulatory body ensures that FINRA has the most current and accurate information on file, fulfilling the firm's ongoing obligation under FINRA Rule 1160 and related guidance. This approach prioritizes regulatory compliance and transparency, mitigating potential risks associated with outdated information. An incorrect approach would be to delay updating the information until the next scheduled annual filing. This failure to act promptly violates the spirit and letter of FINRA rules, which mandate timely updates to reflect changes in key personnel. The regulatory framework expects firms to be proactive in maintaining accurate records, and such a delay could be interpreted as negligence or an attempt to circumvent reporting obligations, leading to potential disciplinary action. Another incorrect approach would be to only inform the firm's internal audit department about the change without directly updating FINRA. While internal reporting is important, it does not satisfy the firm's external regulatory obligation to provide this information to FINRA. This oversight demonstrates a misunderstanding of where the ultimate responsibility for regulatory filings lies and could result in FINRA being unaware of the correct contact person, hindering communication and oversight. A further incorrect approach would be to assume that the previous contact person's information is sufficient for a transitional period. FINRA rules require the most current information to be on file. Relying on outdated information, even temporarily, creates a compliance gap and exposes the firm to regulatory risk. The firm must ensure that FINRA records accurately reflect the current Chief Compliance Officer at all times. Professionals should employ a decision-making framework that prioritizes regulatory compliance as a foundational element of operations. This involves understanding the specific requirements of relevant regulatory bodies, such as FINRA rules on member filings and contact information. When a change occurs that impacts these requirements, the professional should immediately identify the necessary steps to comply, consult relevant regulatory guidance, and execute those steps promptly and accurately. A proactive approach to compliance, rather than a reactive one, is crucial for maintaining a firm's integrity and avoiding regulatory penalties. Question 3. Performance analysis shows a material discrepancy in the general ledger accounts of a California-registered broker-dealer that is preventing the trial balance from balancing. As the financial and operations principal, FINRA, what is the most appropriate immediate course of action? Option A. Proceed with the preparation of the trial balance, noting the discrepancy to be investigated and corrected after the trial balance is completed. Option B. Ignore the discrepancy and proceed with the trial balance preparation, assuming it is a minor error that will resolve itself. Option C. Make an arbitrary adjustment to one of the accounts to force the trial balance to balance, without investigating the cause of the discrepancy. Option D. Thoroughly investigate the discrepancy, identify its root cause, and make necessary corrections to the general ledger before proceeding with the preparation of the trial balance. The correct answer is D. Thoroughly investigate the discrepancy, identify its root cause, and make necessary corrections to the general ledger before proceeding with the preparation of the trial balance. Explanation. Scenario analysis. This scenario presents a common challenge for a financial and operations principal, FINRA, in California, requiring them to ensure the accuracy and integrity of the firm's financial records. The challenge lies in balancing the need for timely financial reporting with the absolute requirement for accurate data, especially when discrepancies arise that could impact regulatory filings and investor confidence. The FINRA must navigate potential pressures to expedite processes while upholding their fiduciary duty to the firm and its clients. Correct approach analysis. The best professional practice involves a thorough investigation and reconciliation of the identified discrepancy before proceeding with the trial balance preparation. This approach prioritizes accuracy and regulatory compliance. The FinUp should meticulously trace the transaction, identify the source of the error, e.g., data entry mistake, system glitch, incorrect posting, and make the necessary corrections. This aligns with the requirements of the Securities and Exchange Commission, SEC Rules 17A3 and 17A4, which mandate accurate and current books and records. California Corporations Code and relevant FINRA rules also emphasize the importance of maintaining accurate financial records for the protection of investors and the integrity of the securities markets. By resolving the discrepancy first, the FinUp ensures the trial balance accurately reflects the firm's financial position, preventing potential misstatements in subsequent financial statements and regulatory filings. Incorrect approach is analysis. Proceeding with the trial balance preparation while acknowledging the discrepancy with the intention of correcting it later is professionally unacceptable. This approach risks creating a trial balance that does not accurately represent the firm's financial condition. If this inaccurate trial balance is used for subsequent financial reporting or regulatory filings, it constitutes a violation of SEC Rule 17A3 and 17A4, as well as potentially misleading regulatory bodies. It also undermines the principle of maintaining books and records that are current and accurate. Ignoring the discrepancy and proceeding with the trial balance preparation without any intention of investigating or correcting it is a severe ethical and regulatory failure. This demonstrates a disregard for the accuracy of financial records, which is a fundamental responsibility of a FinUp. Such an action would directly violate the spirit and letter of SEC rules regarding record keeping and could lead to significant penalties, including fines and disciplinary actions from regulatory bodies like FINRA and the California Department of Financial Protection and Innovation. Making an arbitrary adjustment to force the trial balance to balance without understanding the underlying cause of the discrepancy is also professionally unsound. While it might achieve a balanced trial balance, it masks the actual error and does not correct the root cause. This practice is deceptive and violates the principles of accurate financial reporting. It fails to meet the requirements of maintaining true and accurate books and records, as mandated by regulatory frameworks. Professional reasoning. Professionals in this role must adopt a systematic approach to financial record keeping. When faced with discrepancies, the primary focus should always be on identifying and rectifying the error before finalizing financial reports. This involves a commitment to accuracy, adherence to regulatory mandates for record keeping, and an understanding that the integrity of financial data is paramount. A robust internal control system, coupled with diligent investigation and reconciliation procedures, forms the bedrock of responsible financial operations. The decision-making process should prioritize transparency and accuracy, ensuring that all financial reporting is based on sound and verifiable data. Question 4. The efficiency study reveals a need to reassess how employee complaints of discrimination are handled within the firm's California operations. Which of the following strategies best aligns with statutory requirements and ethical best practices for managing employment discrimination claims? Option A. Discourage employees from formally filing grievances by emphasizing informal resolution channels and discouraging documentation of complaints. Option B. Focus on reducing the time it takes to close employee complaints by standardizing responses and limiting the scope of investigations to expedite the process. Option C. Implement a comprehensive review of existing grievance policies and procedures, ensuring they are compliant with the California Fair Employment and Housing Act and federal anti-discrimination laws, coupled with mandatory training for all relevant personnel on handling such claims impartially and confidentially. Option D. Delegate the handling of all discrimination complaints to a single, overworked individual to centralize expertise and minimize departmental involvement. The correct answer is C. Implement a comprehensive review of existing grievance policies and procedures, ensuring they are compliant with the California Fair Employment and Housing Act and federal anti-discrimination laws, coupled with mandatory training for all relevant personnel on handling such claims impartially and confidentially. Explanation. The efficiency study reveals a potential need to reevaluate internal procedures for handling employee grievances, particularly those alleging statutory employment discrimination. This scenario is professionally challenging because it requires balancing the firm's operational efficiency with its legal and ethical obligations to provide a fair and impartial process for all employees. Mismanagement of such claims can lead to significant legal liabilities, reputational damage, and a decline in employee morale. Careful judgment is required to ensure that any changes implemented are compliant with all applicable laws and foster a culture of respect and equity. The best approach involves a thorough review of existing policies and procedures against the backdrop of the California Fair Employment and Housing Act, FEHA, and relevant federal statutes like Title VII of the Civil Rights Act of 1964. This includes ensuring that the grievance process is clearly communicated, accessible to all employees, and provides for prompt, impartial investigation and resolution. Training for managers and HR personnel on identifying, reporting, and addressing discrimination claims is paramount. Furthermore, establishing clear lines of accountability and maintaining confidential records are essential components of a legally sound and ethically responsible process. This approach directly addresses the potential for discrimination claims by proactively strengthening the firm's internal controls and employee protections, thereby mitigating legal risk and fostering a positive work environment. An approach that focuses solely on streamlining the grievance process to reduce administrative burden, without a corresponding emphasis on fairness, impartiality, and thorough investigation, would be professionally unacceptable. This would likely violate the spirit and letter of anti-discrimination laws, which mandate a robust process for addressing such claims. Failing to provide adequate training to those responsible for handling grievances could lead to mishandling of sensitive issues, potentially exacerbating the discrimination claim and increasing legal exposure. Another unacceptable approach would be to discourage employees from filing grievances or to retaliate against those who do. Such actions are not only unethical, but also directly contravene anti-retaliation provisions within employment discrimination laws. This creates a climate of fear and silence, preventing legitimate concerns from being addressed and exposing the firm to severe penalties. Finally, an approach that relies on informal, ad hoc resolutions without documented procedures or proper investigation risks inconsistency and bias. This lack of structure can lead to perceptions of unfairness and may not adequately address the root causes of discrimination, leaving the firm vulnerable to future claims and regulatory scrutiny. Professionals should employ a decision-making framework that prioritizes legal compliance, ethical conduct, and employee well-being. This involves understanding the specific legal requirements of jurisdictions like California, conducting a comprehensive risk assessment of current practices, and developing solutions that are both effective and equitable. Regular review and updates to policies and training programs are crucial to adapt to evolving legal landscapes and best practices in employment law. Question 5. Investigation of a broker-dealer's year-end financial reporting process in New York reveals that the drafted audited financial statements are ready for submission to the SEC and FINRA. The firm's financial and operations principal, FINUP, has a final review scheduled before the filing deadline. What is the most appropriate course of action for the FINUP to ensure compliance with U.S. securities regulations? Option A. Conduct a comprehensive review of the audited financial statements and all supporting schedules for accuracy, completeness, and compliance with GAAP and SEC/FINRA rules, and then electronically file the statements via the appropriate regulatory portal before the deadline. Option B. Submit the audited financial statements immediately to meet the deadline, relying solely on the external auditor's certification to ensure accuracy and completeness. Option C. Delay the filing of the audited financial statements until all minor discrepancies identified during the final review are fully resolved, even if it means missing the regulatory deadline, without prior communication with regulators. Option D. File the audited financial statements with the SEC and FINRA, acknowledging that there are some known material errors, with the intention of filing an amendment shortly thereafter. The correct answer is A. Conduct a comprehensive review of the audited financial statements and all supporting schedules for accuracy, completeness, and compliance with GAAP and SEC/FINRA rules, and then electronically file the statements via the appropriate regulatory portal before the deadline. Explanation. This scenario presents a professional challenge because it requires a financial and operations principal, FinOp, to navigate the complexities of regulatory reporting deadlines and the potential for errors in financial statements, all while operating under the strict oversight of the U.S. Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA. The FinOp must balance the need for timely filing with the imperative of accuracy and compliance, understanding that both delays and inaccuracies can lead to severe regulatory consequences. Careful judgment is required to ensure that all reporting obligations are met without compromising the integrity of the financial information submitted. The correct approach involves a proactive and thorough review process. This entails meticulously examining the drafted audited financial statements and supporting schedules for any discrepancies or omissions before submission. It also requires confirming that all required disclosures are present and accurate, aligning with generally accepted accounting principles, GAAP, and relevant SEC and FINRA rules. Furthermore, it necessitates verifying that the filing is submitted electronically through the appropriate regulatory portal, e.g., FINRA Gateway, by the established deadline. This comprehensive verification ensures compliance with SEC Rule 17a-5, which mandates the timely filing of audited financial statements, and FINRA Rule 4510, which governs record-keeping and reporting requirements. Adhering to these regulations demonstrates diligence and commitment to regulatory integrity. An incorrect approach would be to submit the audited financial statements without a final, detailed review, assuming the external auditors have caught all errors. This fails to acknowledge the FinOp ultimate responsibility for the accuracy and completeness of the filings, as required by SEC Rule 17a-5. The FinOp is not merely a conduit for the auditor's work, but is responsible for the firm's overall financial reporting. Another incorrect approach is to delay the filing beyond the regulatory deadline due to minor, unresolved discrepancies, without seeking an extension or communicating the issue to the regulators. This violates the spirit and letter of SEC Rule 17a-5, which emphasizes timely submission. While accuracy is paramount, uncommunicated delays are viewed as a failure to meet reporting obligations. Finally, submitting the financial statements with known material errors or omissions, even if the intent is to correct them later, is a serious regulatory failure. This directly contravenes the requirement for accurate financial reporting under SEC Rule 17a-5 and FINRA Rule 4510, potentially misleading regulators and investors. Professionals should employ a decision-making framework that prioritizes a multi-stage review process. This includes an initial review of draft financials, a thorough reconciliation of all accounts, a detailed examination of disclosures for compliance with GAAP and regulatory requirements, and a final verification of the submission process and deadline. In situations where significant issues arise close to the deadline, the framework should include protocols for seeking regulatory guidance or filing for extensions, ensuring transparency and proactive communication with the SEC and FINRA. Question 6. Comparative studies suggest that firms operating under U.S. generally accepted accounting principles, GAAP, face complexities in revenue recognition for long-term service contracts. A New York-based financial services firm has entered into a 3-year advisory contract with a client. The contract stipulates a fixed monthly retainer and a significant performance bonus payable only upon the successful completion of the contract term and achievement of specific measurable client objectives. The firm has begun providing advisory services. Which of the following approaches best reflects the appropriate revenue recognition under U.S. GAAP for this contract? Option A. Recognize all revenue, including the fixed retainer and the performance bonus, only at the end of the 3-year contract term when all services are completed and all payments are received. Option B. Recognize revenue solely based on the cash received from the client each month, irrespective of the services rendered or contract milestones achieved. Option C. Recognize the entire contract value, including the potential performance bonus, upfront upon signing the contract, as this represents the total potential revenue. Option D. Recognize the fixed monthly retainer ratably over the 3-year contract term as services are rendered, and recognize the performance bonus only when the client's objectives are definitively met, and the bonus is contractually earned and assured. The correct answer is D. Recognize the fixed monthly retainer ratably over the 3-year contract term as services are rendered, and recognize the performance bonus only when the client's objectives are definitively met, and the bonus is contractually earned and assured. Explanation: the scenario presents a common challenge in financial operations, accurately recognizing revenue when a significant portion of the service is delivered over time, but payment is contingent on future events. This requires careful adherence to the Financial Accounting Standards Board (FASB) Accounting Standards Codification, ASC 606, Revenue from Contracts with Customers, which governs revenue recognition in the United States. The challenge lies in determining the appropriate timing and amount of revenue to recognize, balancing the firm's desire to reflect its performance with the need for objective and verifiable financial reporting. This application can lead to misleading financial statements, impacting investor confidence and regulatory compliance. The best approach involves recognizing revenue as performance obligations are satisfied over time, in accordance with ASC 606. This means identifying the distinct performance obligations within the contract, determining the transaction price, and allocating that price to each performance obligation. Revenue is then recognized when control of the promised goods or services is transferred to the customer. For services rendered over time, this typically means recognizing revenue ratably over the service period, or based on the progress towards completion, provided certain criteria are met. This method aligns with the principle of reflecting the economic substance of the transaction and providing a faithful representation of the company's financial performance. An incorrect approach would be to recognize the entire contract value upfront upon signing the agreement. This fails to acknowledge that the firm has not yet fulfilled its obligations and has not yet earned the full amount. ASC 606 explicitly prohibits recognizing revenue until performance obligations are satisfied and control is transferred. Another incorrect approach is to defer all revenue until the contract is fully completed and all contingent payments are received. This would misrepresent the firm's performance during the contract term and violate the matching principle, which aims to recognize expenses and revenues in the same period. Finally, recognizing revenue based solely on cash received, without regard to the performance obligations satisfied, is also incorrect. Cash receipts do not necessarily equate to earned revenue under ASC 606. Professionals should approach such situations by meticulously analyzing the contract terms, identifying all performance obligations, and applying the 5-step model outlined in ASC 606. This involves understanding the nature of the goods or services, the customer's ability to benefit from them, and the transfer of control. When performance obligations are satisfied over time, professionals must select an appropriate measure of progress, e.g., time-based, output-based, that accurately reflects the transfer of control to the customer. Consulting with accounting experts and ensuring robust internal controls over revenue recognition processes are crucial for maintaining compliance and ethical financial reporting. Question 7. Assessment of a member firm's response to a customer complaint regarding a significant trading error in New York. What is the most appropriate initial action for the firm's principal to take, considering the FINRA Code of Mediation Procedure? Option A. Initiate the firm's internal complaint handling process, and if unresolved, offer to engage in mediation under the FINRA Code of Mediation Procedure. Option B. Advise the customer to pursue legal action directly and refuse any further discussion. Option C. Immediately compensate the customer for the full amount of the perceived trading loss to avoid further escalation. Option D. Suggest the customer file a formal arbitration claim without first exploring mediation. The correct answer is A. Initiate the firm's internal complaint handling process, and if unresolved, offer to engage in mediation under the FINRA Code of Mediation Procedure. Explanation: scenario analysis. This scenario presents a professional challenge because it involves a dispute between a member firm and a customer regarding a trading error. The firm's principal must navigate the firm's internal procedures and the FINRA Code of Mediation Procedure to resolve the issue fairly and efficiently, while also considering the potential impact on the firm's reputation and client relationship. Careful judgment is required to ensure compliance with regulatory obligations and to maintain client trust. Correct approach analysis. The best professional practice involves initiating the firm's internal complaint handling process and, if unresolved, promptly offering to engage in mediation under the FINRA Code of Mediation Procedure. This approach is correct because it demonstrates the firm's commitment to resolving disputes amicably and efficiently, as encouraged by FINRA. The Code of Mediation Procedure is designed to provide a cost-effective and timely alternative to litigation, and by offering mediation, the firm adheres to the spirit of regulatory guidance aimed at fostering fair dispute resolution. This proactive stance aligns with the firm's obligation to treat customers fairly and to operate in a manner that upholds the integrity of the securities markets. Incorrect approaches analysis. Offering to immediately compensate the customer for the full amount of the perceived loss without a thorough investigation or attempting internal resolution fails to adhere to the firm's obligation to conduct a proper review of trading errors. This approach bypasses established procedures and could set a precedent for unwarranted payouts, potentially exposing the firm to financial risk and regulatory scrutiny for inadequate internal controls. Refusing to engage in any form of dispute resolution and instead advising the customer to pursue legal action directly is professionally unacceptable. This approach neglects the firm's responsibility to provide a reasonable avenue for dispute resolution and ignores the availability of mechanisms like mediation, which are encouraged by FINRA to resolve customer-firm disputes. It can be perceived as an unwillingness to cooperate and could lead to more costly and time-consuming legal battles. Suggesting that the customer file a formal arbitration claim without first exploring mediation is also an incorrect approach. While arbitration is a valid dispute resolution mechanism, the FINRA Code of Mediation Procedure explicitly encourages mediation as a preliminary step for certain disputes. Skipping mediation when it is appropriate and available means the firm is not fully utilizing the available tools for efficient and cost-effective dispute resolution, potentially increasing the burden on both the customer and the firm. Professional reasoning. Professionals should approach customer disputes by first understanding the firm's internal complaint resolution policies. If internal resolution is not achieved, they should consider the applicability of FINRA dispute resolution mechanisms, prioritizing mediation as a cost-effective and efficient first step for eligible disputes, as outlined in the Code of Mediation Procedure. This systematic approach ensures fairness, regulatory compliance, and the preservation of client relationships. Question 8. The efficiency study reveals that a New York-based broker-dealer's proprietary trading desk has been accounting for gains and losses on various financial instruments. The FINUP is reviewing the accounting treatment for these transactions, which include both short-term trading positions and longer-term investments in corporate bonds. Which of the following accounting treatments best adheres to generally accepted accounting principles, GAAP, as established by the Financial Accounting Standards Board, FASB, for these diverse trading activities? Option A. Recognize unrealized gains and losses on all trading securities in net income as they occur, and account for corporate bonds based on their classification e.g. trading, available for sale, held to maturity, with appropriate recognition of gains, losses, and interest income according to relevant FASB ASC guidance. Option B. Defer the recognition of any unrealized losses on trading securities until the securities are sold to present a more conservative financial position. Option C. Aggregate all gains and losses from proprietary trading activities into a single trading revenue line item, recognizing only realized gains and losses to avoid volatility in net income. Option D. Apply a consistent accounting method for all proprietary trading instruments, regardless of their classification or intent, to simplify financial reporting. The correct answer is A. Recognize unrealized gains and losses on all trading securities in net income as they occur, and account for corporate bonds based on their classification, e.g. trading, available for sale, held to maturity, with appropriate recognition of gains, losses, and interest income according to relevant FASB ASC guidance. Explanation. The efficiency study reveals a potential discrepancy in how a New York-based broker-dealer accounts for certain revenue streams, specifically related to proprietary trading gains and losses. This scenario is professionally challenging because it requires the financial and operations principle, FINUP, to exercise sound judgment in applying generally accepted accounting principles, GAAP, as established by the Financial Accounting Standards Board, FASB, to complex financial instruments and transactions. Misapplication of GAAP can lead to materially misstated financial statements, regulatory violations, and damage to investor confidence. The FINUP must navigate the nuances of FASB pronouncements to ensure accurate financial reporting. The best approach involves a thorough review of the specific nature of the proprietary trading activities and the relevant FASB accounting standards codification, Ask topics. This includes identifying whether the instruments are classified as trading securities, available for sale securities, or held to maturity securities, and applying the corresponding recognition and measurement guidance. For instance, ask 320 investments, debt and equity securities, and ask 820 fair value measurement are critical. The FinUp must ensure that unrealized gains and losses on trading securities are recognized in net income, and that fair value is determined using appropriate valuation techniques as outlined in ASC 820. This adherence to specific FASB guidance ensures compliance with GAAP and regulatory requirements for accurate financial reporting, as mandated by the Securities and Exchange Commission, SEC, and FINRA rules for broker-dealers operating in New York. An incorrect approach would be to simply aggregate all trading gains and losses into a single trading revenue line item, without differentiating between realized and unrealized components, or considering the classification of the underlying securities. This fails to comply with the specific recognition and measurement principles of GAAP, particularly concerning the timing of income recognition for unrealized gains. Another incorrect approach would be to defer recognition of unrealized losses on trading securities, arguing for a more conservative reporting stance. This directly violates the principle of recognizing all gains and losses on trading securities in net income as they occur, as per FASB guidance. Finally, relying solely on industry custom or past practices without consulting the latest FASB pronouncements would be a failure to adhere to the current regulatory framework for financial reporting. Professionals should employ a systematic decision-making process that begins with understanding the specific transaction or account. This involves identifying the relevant accounting standards, FASB Ask, consulting authoritative literature, and if necessary, seeking clarification from accounting experts or the firm's independent auditors. The FinUp must prioritize accuracy and compliance over expediency, ensuring that all financial reporting reflects the economic substance of transactions in accordance with GAAP. Question 9. Regulatory review indicates that a registered broker-dealer in New York has an aggregate credit risk exposure to a single affiliated entity. The firm's net capital, as of the most recent Focus report filing, is $50,000,000. The aggregate credit risk exposure to this affiliated entity, calculated by including direct loans, guarantees, and commitments to purchase securities, amounts to $13,000,000. If the firm also has outstanding derivative contracts with the same entity that, under the definition of Rule 17H2T, represent an additional $2,000,000 in credit risk exposure, what is the total aggregate credit risk exposure to this entity that must be considered for reporting purposes under SEC Rule 17H2T? Option A, $10,000,000. Option B, $13,000,000. Option C, $15,000,000. Option D, $12,500,000. Correct answer is C, $15,000,000. Explanation: Scenario analysis. This scenario is professionally challenging because it requires a principal to accurately assess and report a firm's financial risk exposure under SEC Rule 17H2T, specifically concerning its large exposure to a particular entity. Miscalculating or mischaracterizing this exposure can lead to significant regulatory penalties, reputational damage, and potential financial instability for the firm. The principal must navigate complex calculations and understand the nuances of what constitutes a large exposure, as defined by the SEC. Correct approach analysis. The best professional practice involves a meticulous calculation of the firm's aggregate exposure to the specified entity, considering all relevant financial instruments and commitments. This includes not only direct lending, but also guarantees, commitments to purchase securities, and potential losses from derivative positions. The calculation should adhere strictly to the methodology outlined in SEC Rule 17H2T, which defines large exposure based on a percentage of the broker-dealer's net capital. Specifically, Rule 17H2T A2I defines a large exposure as an aggregate amount of credit risk exposure to any single entity that exceeds 25% of the broker-dealer's net capital. The principal must then accurately report this calculated exposure if it meets or exceeds this threshold. This approach is correct because it directly applies the SEC's regulatory definition and reporting requirements, ensuring compliance and accurate risk disclosure. Incorrect approach is analysis. One incorrect approach is to only consider direct loans to the entity and ignore other forms of credit risk, such as guarantees or commitments to purchase securities. This fails to capture the full scope of the firm's exposure as mandated by Rule 17H2T, which requires an aggregate calculation of credit risk. This omission would lead to an underreporting of the large exposure if these other commitments push the total exposure over the 25% net capital threshold. Another incorrect approach is to use a subjective assessment of the entity's financial health rather than a quantitative calculation based on the SEC's rule. While understanding the counterparty's financial health is important for overall risk management, Rule 17H2T mandates a specific quantitative threshold for reporting large exposures. Relying solely on subjective judgment bypasses the regulatory requirement for a precise calculation and reporting. A third incorrect approach is to exclude certain derivative positions from the aggregate exposure calculation, even if they represent a significant credit risk to the firm. Rule 17H2T's definition of aggregate credit risk exposure is broad and is intended to encompass all forms of credit risk, including those arising from derivative contracts. Failing to include these positions would result in an incomplete and non-compliant calculation of the firm's exposure. Professional reasoning. Professionals must adopt a systematic and rule-based approach when dealing with regulatory reporting requirements. This involves 1. Thoroughly understanding the specific rule, SEC Rule 17H2T in this case, and its definitions. 2. Identifying all relevant financial instruments and commitments that contribute to the exposure. 3. Performing precise quantitative calculations as prescribed by the rule. 4. Comparing the calculated exposure against the defined thresholds. 5. Reporting accurately and in a timely manner if the thresholds are met. When in doubt, consulting with legal counsel or compliance experts is crucial to ensure adherence to the spirit and letter of the regulations. Question 10. Consider a scenario in New York where a registered representative notices that a customer's account information, specifically their employment status, has not been updated in over 3 years. The firm's internal policy allows for accounts to continue operating with outdated information for up to 5 years before requiring an update. What is the most appropriate course of action for the principal to ensure compliance with New York's regulatory framework and best practices for customer account maintenance? Option A. Initiate a process to contact the customer immediately to obtain updated employment information and document these efforts. Option B. Advise the registered representative to ignore the discrepancy as it falls within the firm's internal policy timeframe for outdated information. Option C. Recommend closing the customer's account due to the outdated employment information as it poses a potential risk. Option D. Continue to allow the account to operate as is, relying on the firm's internal policy that permits operation with outdated information for up to 5 years. The correct answer is A. Initiate a process to contact the customer immediately to obtain updated employment information and document these efforts. Explanation. This scenario presents a professional challenge because it requires a principal to balance the firm's operational needs with strict adherence to regulatory requirements concerning customer account information. The principal must exercise careful judgment to ensure compliance without unduly hindering legitimate business operations. The core of the challenge lies in interpreting and applying the specific rules regarding the maintenance and accessibility of customer account information, particularly when dealing with potentially outdated or incomplete data. The best professional practice involves proactively identifying and addressing discrepancies in customer account information by initiating the required update procedures. This approach prioritizes regulatory compliance and customer protection by ensuring that all account records are accurate and current. Specifically, it entails contacting the customer to obtain the necessary updated information and documenting the efforts made. This aligns with FINRA Rule 4511, General Provisions, which mandates that firms maintain accurate and current books and records. Furthermore, it reflects the ethical obligation to act with diligence and care in all dealings with customers and in maintaining their financial information. An incorrect approach would be to simply ignore the discrepancy and continue to operate the account without attempting to update the information. This failure to act directly violates the requirement to maintain accurate records and could expose both the firm and the customer to risks associated with outdated information, such as miscommunication or inappropriate transaction execution. It also breaches the duty of care owed to the customer. Another incorrect approach is to rely on assumptions or internal firm policies that permit operating with outdated information for a specified period without active efforts to update it. While firms may have internal procedures for handling such situations, these procedures must still comply with the overarching regulatory mandate for accuracy. Circumventing the direct requirement to update information by relying on internal workarounds, especially if they don't involve direct customer engagement for correction, is a regulatory failure. A further incorrect approach would be to close the account solely due to the discrepancy without first making a diligent effort to obtain updated information from the customer. While account closure might be a last resort, it should not be the initial response to a record-keeping issue, especially if the customer is otherwise in good standing and willing to provide the necessary updates. This could be seen as an unreasonable action that negatively impacts the customer relationship and may not be the most compliant or ethical first step. The professional reasoning framework for such situations involves a hierarchical approach. First, understand the specific regulatory requirements. Second, assess the nature and impact of the discrepancy. Third, determine the most compliant and customer-centric course of action, which typically involves direct communication and diligent efforts to rectify the issue. And finally, document all actions taken. Question 11. Upon reviewing the firm's internal audit report for the past quarter, the Financial and Operations Principal, FINOP, for a broker-dealer registered in California, discovers that several key client account statements have not been updated for over 2 months, and the firm's monthly electronic filings for the same period are incomplete due to these record-keeping delays. What is the most appropriate immediate course of action for the FINOP to ensure regulatory compliance? Option A. Immediately direct the responsible personnel to update all outstanding client account statements and complete the pending electronic filings, establishing a clear timeline for rectification and implementing enhanced oversight to prevent future delays. Option B. Instruct the accounting department to make best efforts corrections to the client account statements and electronic filings based on available information, and to document these efforts for future reference. Option C. Advise the compliance department to file an amendment to the most recent electronic filing, noting the discrepancies in client account statements and requesting an extension for the remaining filings. Option D. Inform the registered representatives responsible for the affected client accounts that they must personally rectify the statement inaccuracies and ensure the completion of their respective electronic filing components. The correct answer is A. Immediately direct the responsible personnel to update all outstanding client account statements and complete the pending electronic filings, establishing a clear timeline for rectification and implementing enhanced oversight to prevent future delays. Explanation. This scenario presents a professional challenge because it involves a direct conflict between the operational demands of a busy firm and the stringent regulatory requirements for maintaining accurate and current books and records, particularly concerning electronic filings. The principal must balance the need for efficient business operations with their fiduciary duty to ensure compliance, which directly impacts the firm's ability to conduct business and its reputation. The potential for significant regulatory penalties and operational disruption necessitates careful and informed decision-making. The best approach involves immediately addressing the identified deficiencies by initiating a process to update the books and records and ensuring all electronic filings are completed accurately and on time. This proactive stance demonstrates a commitment to regulatory compliance and mitigates potential harm to the firm and its clients. Specifically, the principal should direct the responsible personnel to rectify the inaccuracies and omissions, establish a clear timeline for completion, and implement internal controls to prevent recurrence. This aligns with FINRA Rule 17A3 and 17A4, which mandate the maintenance of current and accurate books and records, and the SEC's emphasis on timely and accurate electronic filings through systems like the Focus Report. An incorrect approach would be to delay addressing the issues, hoping they will resolve themselves or be overlooked. This failure to act promptly violates the core principles of regulatory compliance and demonstrates a disregard for the firm's obligations. Such inaction could lead to severe consequences, including regulatory sanctions, fines, and potential suspension or revocation of the firm's registration. Another incorrect approach is to attempt to correct the records without a systematic process or proper documentation. This might involve making ad hoc changes that could further complicate the audit trail or create new inaccuracies. It fails to address the root cause of the problem and does not establish the necessary controls to prevent future issues, thus violating the spirit and letter of regulatory requirements for record keeping and reporting. Finally, an incorrect approach is to delegate the entire responsibility for rectifying the situation to junior staff without adequate oversight or guidance. While delegation is a necessary management tool, the ultimate responsibility for compliance rests with the principal. Failing to provide sufficient oversight or to ensure that the corrections are made accurately and in accordance with regulations shifts the burden inappropriately and increases the risk of further noncompliance. Professionals should employ a decision-making framework that prioritizes regulatory adherence. This involves 1. Identifying the specific compliance issue and its potential impact. 2. Consulting relevant regulations and firm policies. 3. Developing a clear, actionable plan to rectify the issue, including timelines and responsible parties. 4. Implementing robust internal controls to prevent future occurrences. 5. Documenting all actions taken and maintaining open communication with regulatory bodies if necessary. Question 12. When evaluating the annual audit and financial reporting requirements for a broker-dealer registered in California under SEC Rule 17a-5, what is the most appropriate course of action for the Financial and Operations Principal, FINOP, when the independent auditor identifies potential material weaknesses in the firm's internal controls over financial reporting? Option A. Instruct the independent auditor to exclude any mention of internal control deficiencies from the audit report to avoid a qualified opinion and potential regulatory scrutiny. Option B. Wait until the audit is substantially complete to raise concerns with the independent auditor about the identified weaknesses, hoping to find a way to minimize their impact on the final report. Option C. Proactively discuss the identified weaknesses with the independent auditor. Review the auditor's findings in relation to Rule 17a-5 requirements, and prepare to facilitate the inclusion of a qualified opinion in the audit report if necessary. Option D. Assume the independent auditor will independently identify and report all relevant Rule 17a-5 requirements without further input from the firm. Correct answer is C. Proactively discuss the identified weaknesses with the independent auditor. Review the auditor's findings in relation to Rule 17a-5 requirements, and prepare to facilitate the inclusion of a qualified opinion in the audit report if necessary. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a financial and operations principal, FINOP, to navigate the complexities of Rule 17a-5 reporting under the Securities Exchange Act of 1934, specifically concerning the annual audit and financial statements. The FINOP must ensure compliance with SEC regulations, while also considering the firm's operational realities and the auditor's independence. Misinterpreting or misapplying these rules can lead to significant regulatory penalties, reputational damage, and potential harm to investors. The core challenge lies in balancing the strict requirements of the rule with the practicalities of an audit engagement. Correct approach analysis. The best professional practice involves proactively engaging with the independent auditor to discuss the scope of the audit and the specific requirements of Rule 17a-5, including the need for a qualified opinion if material deficiencies are found. This approach ensures that the auditor understands their obligations under the rule and that the firm is prepared for the audit process. The FINOP should facilitate open communication, provide necessary documentation, and address any auditor concerns promptly. This aligns with SEC expectations for broker-dealers to maintain accurate financial records and undergo rigorous audits, as mandated by Rule 17a-5, which requires the submission of audited financial statements and a report on internal controls. A qualified opinion, if necessary, is a transparent disclosure of issues, which is preferable to attempting to conceal or downplay them. Incorrect approach is analysis. One incorrect approach is to assume the auditor will independently identify all Rule 17a-5 requirements without specific firm guidance. While auditors are expected to be knowledgeable, the FINOP has a direct responsibility to ensure the firm's compliance with the rule. Failing to proactively discuss the rule's implications with the auditor could lead to oversights or misunderstandings, potentially resulting in an incomplete or inaccurate audit report. This approach neglects the FINRA affirmative duty to facilitate compliance. Another incorrect approach is to instruct the auditor to omit any mention of internal control deficiencies to avoid a qualified opinion. This is a direct violation of Rule 17a-5, which mandates reporting on internal controls and requires a qualified opinion if material weaknesses are identified. Attempting to suppress such findings is unethical and illegal, undermining the purpose of the audit and the regulatory oversight intended to protect investors. A third incorrect approach is to wait until the audit is nearly complete to address potential issues with the auditor. This reactive stance can create undue pressure, hinder thoroughness, and may not allow sufficient time for the auditor to properly investigate and report on any identified problems. Proactive engagement is crucial for a smooth and compliant audit process. Professional reasoning. Professionals facing similar situations should adopt a proactive and collaborative approach. The decision-making process should prioritize understanding the specific regulatory requirements. In this case, Rule 17a-5, engaging in open and honest communication with all relevant parties, especially the independent auditor, and ensuring that all disclosures are accurate and complete. When in doubt, seeking clarification from regulatory bodies or legal counsel is advisable. The ultimate goal is to uphold the integrity of financial reporting and investor protection, which necessitates transparency and adherence to all applicable laws and rules. Question 13. The analysis reveals that a California-based FINRA member firm is exploring options to bolster its capital. The firm's registered principal is considering a proposed subordinated loan agreement. Which of the following actions best ensures this loan will be recognized as qualifying capital under FINRA Rule 4110E? Option A. Negotiating a subordinated loan with a term of 6 months, with all other standard subordination clauses included. Option B. Accepting a subordinated loan agreement that permits the lender to demand repayment upon the occurrence of a material adverse change in the firm's financial condition, provided FINRA consent is still required for the demand. Option C. Verifying that the loan agreement has a minimum term of at least 1 year, is unsecured, and includes provisions that the lender cannot demand repayment or accelerate the loan without the consent of FINRA and the firm's designated examining authority. Option D. Structuring the subordinated loan as a secured borrowing, with the firm's own securities pledged as collateral. The correct answer is C. Verifying that the loan agreement has a minimum term of at least 1 year, is unsecured, and includes provisions that the lender cannot demand repayment or accelerate the loan without the consent of FINRA and the firm's designated examining authority. Explanation. The analysis reveals a scenario where a FINRA member firm, operating in California, is seeking to strengthen its capital position. The firm's registered principal is evaluating different methods to achieve this, specifically concerning subordinated loans and capital borrowings. This situation is professionally challenging, because the principal must ensure that any capital infusion genuinely contributes to the firm's financial stability and meets the stringent requirements of FINRA Rule 4110E and related SEC regulations, without creating hidden liabilities or misleading regulators. The principal's judgment is critical to avoid regulatory violations and maintain the firm's operational integrity. The best approach involves a thorough review of the proposed subordinated loan agreement to confirm it meets all FINRA and SEC requirements for subordinated debt. This includes verifying that the loan has a minimum term of at least 1 year, is unsecured, and is subordinated to all claims of the firm's present and future creditors. Crucially, the agreement must also stipulate that the lender cannot demand repayment or accelerate the loan without the consent of FINRA and the firm's designated examining authority. This approach is correct because it directly addresses the regulatory intent of Rule 4110E, which is to ensure that capital is available to the firm and not subject to immediate withdrawal, thereby safeguarding customer assets and the firm's ability to meet its obligations. Adhering to these specific terms ensures the loan is recognized as true capital. An incorrect approach would be to accept a subordinated loan agreement that includes a clause allowing the lender to demand repayment upon the occurrence of a material adverse change in the firm's financial condition, even if FINRA consent is still technically required for the demand. This is professionally unacceptable because it introduces a significant risk of capital withdrawal that is not adequately controlled by the agreement, potentially undermining the purpose of the subordinated loan as a stable capital component. It also creates ambiguity regarding the lender's rights, which could be interpreted as a violation of the spirit and letter of the subordination requirements. Another incorrect approach would be to treat a loan secured by the firm's own securities as a qualifying subordinated loan. This is professionally unacceptable, as Rule 4110E and related interpretations generally require subordinated debt to be unsecured. Collateralizing the loan with the firm's assets, even its own securities, creates a claim on those assets that could be realized by the lender, thereby reducing the firm's net capital and potentially impacting its ability to meet obligations to other creditors. Finally, accepting a subordinated loan with a term of less than 1 year, even if all other conditions are met, is professionally unacceptable. FINRA rules mandate a minimum term to ensure the capital is available for a sufficient period to provide genuine financial support. A short-term loan does not meet this requirement and would not be recognized as qualifying capital, potentially leading to net capital deficiencies. Professionals should employ a decision-making framework that prioritizes strict adherence to regulatory definitions and requirements. This involves meticulously reviewing all documentation related to capital borrowings and subordinated loans against the specific rules of FINRA and the SEC. When in doubt, seeking clarification from the firm's compliance department or directly from FINRA is essential. The focus should always be on whether the proposed arrangement genuinely enhances the firm's capital base in a way that is recognized by regulators and provides a buffer against financial distress, rather than merely appearing to do so. Question 14. Strategic planning requires a California-based broker-dealer to accurately classify a security lending transaction where the firm acts as the borrower. The firm has posted cash collateral to the lender. Which of the following best reflects the regulatory classification and recognition of this transaction for net capital purposes under SEC Rule 15C3-1? Option A. The cash collateral posted is recognized as an allowable asset, and the obligation to return the collateral is not considered a liability for net capital purposes. Option B. The cash collateral posted is recognized as a non-allowable asset, and the obligation to return the collateral and pay any associated fees is recognized as a liability. Option C. The entire transaction is treated as a simple cash deposit with no specific regulatory classification beyond standard accounting. Option D. The cash collateral posted is recognized as an allowable asset, and the obligation to return the collateral and pay any associated fees is recognized as a liability. Correct answer is B. The cash collateral posted is recognized as a non-allowable asset, and the obligation to return the collateral and pay any associated fees is recognized as a liability. Explanation. Strategic planning requires a firm understanding of how regulatory frameworks dictate the classification and recognition of financial instruments. In the context of FINRA Series 27, specifically concerning a broker-dealer operating in California, accurately categorizing assets and liabilities is paramount for accurate financial reporting, net capital computations, and compliance with SEC Rule 15C3-1. The challenge lies in distinguishing between instruments that are treated as capital or allowable assets versus those that represent liabilities or non-allowable assets, especially when dealing with complex or novel financial products. Misclassification can lead to violations of net capital rules, potentially jeopardizing the firm's ability to operate. The best approach involves a meticulous review of the specific terms and conditions of the financial instrument, cross-reference with the relevant sections of the SEC's Net Capital Rule 15C3-1, and any applicable interpretations or guidance from FINRA and the California Department of Financial Protection and Innovation. This includes understanding the nature of the underlying asset, the contractual obligations, and the potential for loss or volatility. For a security lending agreement where the broker-dealer is the borrower, the collateral provided is typically considered an asset, but the obligation to return that collateral, along with any associated fees, constitutes a liability. The treatment of the collateral itself, e.g., cash, securities, and the potential for margin calls or defaults must be carefully assessed to determine its impact on net capital. An incorrect approach would be to assume that any collateral posted in a lending agreement is automatically an allowable asset, without considering the firm's obligation to return it. This overlooks the liability component and can lead to an overstatement of net capital. Another flawed approach is to treat the entire transaction as a simple deposit or loan without considering the specific regulatory definitions and haircuts applied to securities lending activities under Rule 15c3-1. This fails to acknowledge the unique risks and regulatory treatment associated with such transactions. Furthermore, relying solely on the accounting treatment without considering the regulatory capital implications is a significant error, as accounting rules may not always align with the stringent requirements of net capital calculations. Professionals should employ a decision-making framework that prioritizes regulatory compliance. This involves 1. Identifying the specific financial instrument and transaction. 2. Consulting the primary regulatory sources. SEC Rule 15c3-1, FINRA rules, state regulations. 3. Analyzing the instrument's characteristics against the definitions and requirements within those regulations. 4. Determining the appropriate classification for net capital purposes, including any applicable haircuts or deductions. 5. Documenting the rationale for the classification. Question 15. Implementation of a new client onboarding process in California requires a registered representative to review and execute various agreements. A client presents a standard pre-dispute arbitration agreement that the firm typically uses. Given the requirements of the Sarbanes-Oxley Act's whistleblower protections, what is the most prudent course of action for the representative to ensure compliance and protect the client's rights? Option A. Carefully review the pre-dispute arbitration agreement for any language that could be interpreted as waiving the client's right to pursue claims under federal whistleblower statutes, and consult with the firm's compliance department if any such language is found. Option B. Proceed with the agreement, but verbally inform the client that they should be aware of potential implications for any future whistleblower claims they might have. Option C. Execute the standard pre-dispute arbitration agreement as presented, assuming it is compliant with all federal laws and FINRA regulations. Option D. Rely on the client to understand the terms of the pre-dispute arbitration agreement and to seek legal advice if they have concerns about its impact on potential whistleblower claims. The correct answer is A. Carefully review the pre-dispute arbitration agreement for any language that could be interpreted as waiving the client's right to pursue claims under federal whistleblower statutes, and consult with the firm's compliance department if any such language is found. Explanation. Scenario analysis. This scenario presents a professional challenge for a registered representative in California due to the complex interplay between federal securities law, specifically the Sarbanes-Oxley Act, SOX, whistleblower protections, and FINRA rules governing arbitration agreements. The core difficulty lies in ensuring compliance with the statutory prohibition against pre-dispute arbitration agreements for certain whistleblower claims, while also adhering to firm policies and FINRA regulations. Misinterpreting or misapplying these rules can lead to significant regulatory sanctions, reputational damage, and potential civil liability. Careful judgment is required to navigate these requirements and protect both the client and the firm. Correct approach analysis. The best professional practice involves proactively identifying and flagging any client agreements that might contain pre-dispute arbitration clauses related to potential whistleblower claims under SOX. This approach prioritizes client protection and regulatory compliance by ensuring that the client is fully informed and that their statutory rights are not inadvertently waived. Specifically, it requires the representative to review client agreements for any language that mandates arbitration for disputes arising under whistleblower statutes, such as SOX. Upon identification, the representative should immediately consult with their compliance department to determine the appropriate course of action, which may include advising the client to seek independent legal counsel or ensuring the agreement is modified to exclude such provisions. This aligns with the ethical obligation to act in the client's best interest and the regulatory imperative to uphold the integrity of financial markets and investor protections. Incorrect approaches analysis. Proceeding with the client's agreement without scrutinizing its arbitration clause for potential conflicts with SOX whistleblower protections represents a significant regulatory failure. This approach ignores the explicit statutory prohibition against pre-dispute arbitration agreements for certain claims, thereby potentially depriving the client of their right to pursue claims in court. It also violates the ethical duty to ensure clients understand the terms of their agreements and are not subjected to clauses that undermine their legal rights. Assuming that all standard pre-dispute arbitration agreements are compliant with federal law and FINRA rules without specific review for SOX whistleblower protections is another regulatory misstep. While FINRA rules generally permit pre-dispute arbitration, SOX provides a specific statutory exception that overrides such agreements for certain whistleblower claims. This assumption demonstrates a lack of due diligence and a failure to stay abreast of relevant legal protections for investors. Relying solely on the client's understanding of the agreement's implications regarding whistleblower claims is also professionally unacceptable. While clients have a responsibility to read and understand their agreements, registered representatives have a fiduciary duty to ensure that agreements do not contain clauses that contravene federal law or compromise their client's statutory rights. The representative cannot delegate their compliance responsibility to the client. Professional reasoning. Professionals facing this situation should adopt a risk-based approach centered on proactive compliance and client advocacy. The decision-making process should involve 1. Understanding the specific regulatory landscape. Thoroughly familiarize oneself with relevant federal statutes like SOX and FINRA rules pertaining to arbitration and whistleblower protections. 2. Diligent agreement review. Implement a rigorous process for reviewing all client agreements, paying particular attention to arbitration clauses and their potential applicability to statutory claims. 3. Escalation and consultation. Establish clear protocols for escalating any identified compliance concerns to the firm's compliance department or legal counsel. 4. Client education and protection. Prioritize informing clients about their rights and ensuring that agreements do not contain provisions that waive or limit statutory protections. 5. Continuous learning. Stay updated on evolving regulations and legal interpretations that impact client agreements and investor rights. Question 16. To address the challenge of a newly identified material weakness in the firm's internal control system for financial reporting, which is a critical concern under SEC Rule 17A5H, what is the most appropriate and compliant course of action for a financial and operations principal, FINOP, of a registered broker-dealer in California? Option A. Conduct an independent assessment of the weakness's materiality and decide whether to report it based on personal judgment, without consulting senior management or legal counsel. Option B. Focus exclusively on developing and implementing corrective actions to resolve the material weakness, deferring any formal notification to regulatory bodies until the remediation is complete. Option C. Immediately document the material weakness in detail, including its nature and potential impact, and promptly notify the Securities and Exchange Commission, SEC, and the firm's designated examining authority, D, as mandated by Rule 17A5H. Option D. Delay reporting the material weakness to the SEC and DEA until the firm's annual audit is completed and a comprehensive remediation plan is fully implemented. The correct answer is C. Immediately document the material weakness in detail, including its nature and potential impact, and promptly notify the Securities and Exchange Commission, SEC, and the firm's designated examining authority, D, as mandated by Rule 17A5H. Explanation. Scenario analysis. This scenario presents a significant professional challenge because it involves a potential failure to comply with a critical SEC rule, Rule 17A5H, which mandates prompt notification of noncompliance or material weaknesses. The FINOP, financial and operations principal, is in a position of trust and responsibility, and their judgment directly impacts the firm's regulatory standing, the protection of investors, and the integrity of the financial markets. Failing to act decisively and appropriately when a material weakness is identified can lead to severe regulatory sanctions, reputational damage, and potential harm to clients. The challenge lies in accurately assessing the materiality of the weakness and understanding the precise notification obligations under the rule. Correct approach analysis. The best professional approach involves immediately and thoroughly documenting the identified material weakness, including its nature, potential impact, and the steps being taken to remediate it. Crucially, this approach mandates prompt notification to the Securities and Exchange Commission, SEC, and the firm's designated examining authority, D, as required by Rule 17A5H. This aligns directly with the regulatory intent of the rule, which is to ensure that regulators are made aware of significant control deficiencies in a timely manner so they can assess the associated risks and oversee the firm's corrective actions. The FinUp responsibility extends beyond merely identifying the weakness. It includes fulfilling the explicit reporting requirements to maintain compliance and uphold market integrity. Incorrect approaches analysis, delaying notification until the next scheduled audit or until a full remediation plan is finalized, represents a significant regulatory failure. Rule 17A5H does not permit such delays. It requires prompt notification upon identification of the weakness. This approach risks violating the spirit and letter of the rule, potentially leading to regulatory scrutiny for noncompliance. Attempting to self-assess the materiality of the weakness and deciding not to report it based on a personal judgment, without consulting with senior management or legal counsel, is also professionally unsound. Materiality assessments can be subjective, and the SEC's definition of a material weakness is broad. Failing to report a weakness that is ultimately deemed material by regulators can result in penalties. This approach bypasses established compliance procedures and the collaborative oversight necessary for such critical matters, focusing solely on implementing corrective actions without initiating the required notification process is incomplete. While remediation is essential, it does not absolve the firm of its immediate reporting obligation under Rule 17A5H. The regulators need to be informed of the issue concurrently with or even prior to the full implementation of corrective measures to properly assess the situation and the firm's response. Professional reasoning. Professionals facing such a situation should employ a decision-making framework that prioritizes regulatory compliance and risk management. This framework involves 1. Accurate identification and assessment. Clearly identify and document the deficiency. Understand its potential impact on financial reporting and internal controls. 2. Consultation and verification. If there is any ambiguity regarding materiality or the reporting obligation, consult with senior management, the firm's compliance department, and potentially external legal counsel specializing in securities regulation. 3. Adherence to reporting requirements. Strictly follow the notification procedures outlined in Rule 17A5H, ensuring timely communication to the SEC and the DEA. 4. Documentation of remediation. Concurrently, develop and implement a robust plan to address and remediate the identified weakness, documenting all steps taken. 5. Ongoing monitoring. Continuously monitor the effectiveness of the remediation efforts and provide updates to regulators as required. Question 17. Examination of the data shows that a broker-dealer registered in New York holds a significant position in a security issued by a private company that is not listed on any national securities exchange. The security has limited trading activity and is subject to resale restrictions. As the financial and operations principal, what is the most appropriate approach to determine the net capital treatment of this security under SEC Rule 15C3-1? Option A. Immediately classify the security as non-marketable and apply a 100% haircut without further investigation, given its lack of listing on a major exchange. Option B. Conduct a thorough review of the security's characteristics against the definition of a non-marketable security in SEC Rule 15C3-1C, 2, Roman 7, to determine its fair value and apply the appropriate haircut. Option C. Value the security at its historical cost and apply a standard haircut applicable to listed equity securities. Option D. Assume the security is marketable due to its private issuer status and apply a haircut based on its perceived liquidity, without specific reference to the non-marketable security provisions. The correct answer is B. Conduct a thorough review of the security's characteristics against the definition of a non-marketable security in SEC Rule 15C3-1C, 2, Roman 7, to determine its fair value and apply the appropriate haircut. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a principal to assess the nature of a security held by the firm and its implications for net capital requirements under SEC Rule 15C3-1, specifically concerning non-marketable securities. Misclassifying such a security can lead to an understatement of net capital charges, potentially violating regulatory requirements and jeopardizing the firm's financial stability. The principal must exercise careful judgment to ensure compliance and protect the firm and its customers. Correct approach analysis. The best professional approach involves a thorough review of the security's characteristics against the definition of a non-marketable security as defined in SEC Rule 15C3-1C, 2, Roman 7. This includes examining factors such as the issuer's financial condition, the trading volume, the number of market makers, and any restrictions on resale. If after this diligent review, the security meets the criteria for a non-marketable security, it must be valued at its fair value, and a specific percentage haircut, typically 100% for net capital purposes, must be applied. This approach ensures accurate net capital calculations and adherence to regulatory mandates. Incorrect approach is analysis. One incorrect approach is to assume that any security not actively traded on a major exchange is automatically non-marketable and subject to the highest haircut without further investigation. This fails to acknowledge that some securities, while not listed on major exchanges, may still have sufficient marketability to warrant a different treatment under the rule, or that the rule has specific criteria to be met. Another incorrect approach is to value the security at its book value or a historical cost basis without considering current market conditions or the specific requirements for non-marketable securities. This ignores the fair value principle and the potential for significant fluctuations in value, leading to an inaccurate net capital position. Finally, an incorrect approach is to apply a standard haircut for marketable securities to a security that has been identified as non-marketable, or to apply a haircut that is not specifically prescribed for non-marketable securities under the rule. This demonstrates a misunderstanding of the rule's specific provisions for different types of securities and their impact on net capital. Professional reasoning. Professionals should adopt a systematic approach to evaluating securities for net capital purposes. This involves understanding the definitions and requirements of relevant regulations, such as SEC Rule 15C3-1. When faced with a security that may be non-marketable, the process should begin with a comprehensive review of its characteristics against the regulatory definition. If the security appears to meet the criteria, the next step is to determine its fair value and apply the appropriate haircut as specified by the rule. If there is any doubt or ambiguity, consulting with legal counsel or senior compliance personnel is a prudent step to ensure accurate interpretation and application of the regulations. Question 18. Research into a broker-dealer's operations in New York reveals the acquisition of a portfolio of complex illiquid securities. As the financial and operations principal FINOP, what is the most appropriate course of action to ensure compliance with SEC Rule 15C3-1E? 1. Regarding net capital requirements and notice provisions, given the potential impact of these new assets on the firm's capital. Option A. Conduct a thorough review of the complex securities' impact on the firm's net capital, applying appropriate haircuts, and immediately initiate the notice procedures if net capital is approaching the minimum requirements. Option B. Rely on the trading department's informal assessment that the new securities are not significantly affecting net capital without independent verification. Option C. Delay a detailed assessment of the complex securities' impact on net capital, assuming the firm's overall financial strength is sufficient to absorb any potential fluctuations. Option D. Wait until the firm's net capital falls below the absolute minimum requirement before considering any notification to regulatory bodies. The correct answer is A. Conduct a thorough review of the complex securities' impact on the firm's net capital, applying appropriate haircuts, and immediately initiate the notice procedures if net capital is approaching the minimum requirements. Explanation. The scenario presents a challenge for a financial and operations principal, FINOP, in New York concerning a broker-dealer's compliance with SEC Rule 15C3-1E. 1. Regarding net capital requirements and notice provisions. The core difficulty lies in accurately assessing the firm's financial health and ensuring timely, appropriate notification to regulators when capital levels approach or fall below required thresholds, especially when dealing with complex or unusual financial instruments. The FINOP must exercise sound judgment to interpret the rule's intent and application, balancing operational efficiency with stringent regulatory adherence. The best approach involves a proactive and meticulous review of the firm's financial position, specifically focusing on the impact of the newly acquired complex securities on the firm's net capital. This includes understanding the haircuts applicable to these securities under Rule 15C3-1 and calculating their effect on the firm's net capital. If this review indicates that the firm's net capital is approaching the minimum requirements, e.g., 150% of the minimum dollar amount or 4% of aggregate debit items, the FINUP must immediately initiate the notice procedures as mandated by Rule 15C3-1E1. This involves preparing and filing the required notification with the Securities and Exchange Commission, SEC, and the firm's designated examining authority, D, within the specified timeframe. This approach is correct because it directly addresses the regulatory obligation to monitor net capital and provide timely notice when it is in jeopardy, thereby preventing potential violations and protecting investors. It demonstrates a commitment to regulatory compliance and risk management. An incorrect approach would be to delay the assessment of the complex security's impact on net capital, assuming that the firm's overall financial health is sufficient without a detailed analysis. This failure to promptly evaluate the specific impact of new assets on net capital violates the spirit and letter of Rule 15C3-1E1, which requires ongoing monitoring. Another incorrect approach would be to only consider notifying regulators if the firm's net capital falls below the absolute minimum requirement, ignoring the approaching threshold. Rule 15C3-1E1 explicitly mandates notice when net capital is approaching the minimum, not just when it has already fallen below it. This oversight could lead to a situation where the firm is already in violation before any corrective action is taken or any notification is made. A third incorrect approach would be to rely solely on the trading desk's informal assurance that the new securities are not significantly impacting net capital without independent verification. The FINUP has a fiduciary duty to independently verify financial positions and ensure compliance, not to delegate this critical responsibility to other departments without due diligence. Professionals should adopt a systematic decision-making process that prioritizes regulatory compliance and risk mitigation. This involves 1. Understanding the specific regulatory requirements applicable to the firm's business activities, such as SEC Rule 15C3-1. 2. Proactively monitoring the firm's financial position, especially when new or complex financial instruments are introduced. 3. Performing thorough due diligence and analysis to accurately assess the impact of all assets and liabilities on net capital. 4. Adhering strictly to notification timelines and procedures when net capital levels approach or fall below regulatory thresholds. 5. Seeking clarification from legal counsel or regulatory bodies when in doubt about the interpretation or application of rules. Question 19. A registered broker-dealer in New York is short 1,000 shares of XYZ Corporation, which were due to settle on Tuesday. By Wednesday morning, the shares have not been delivered. The current market price of XYZ is $50 per share, and the firm's records indicate the original sale was executed at $45 per share. The firm's short interest in XYZ is significant. Which approach would be the most appropriate and compliant course of action for the firm? Option A. Immediately execute a buy-in for 1,000 shares of XYZ Corporation at the current market price of $50 per share to cover the failed delivery. Option B. Absorb the potential loss and do not execute a buy-in, assuming the short interest is manageable. Option C. Wait until Thursday to execute a buy-in, hoping the short seller will deliver the shares by then. Option D. Attempt to borrow the shares from another broker without initiating the buy-in process. The correct answer is A. Immediately execute a buy-in for 1,000 shares of XYZ Corporation at the current market price of $50 per share to cover the failed delivery. Explanation. Scenario analysis. This scenario presents a professional challenge due to the potential for significant financial penalties and reputational damage associated with failing to deliver securities on settlement date. The firm's short interest position amplifies the risk, as a failure to deliver can lead to buy-ins, increased costs, and regulatory scrutiny. Accurate calculation and timely resolution of fails are paramount to maintaining market integrity and client trust. Correct approach analysis. The best approach involves immediately identifying the fail, calculating the buy-in cost based on the current market price, and executing the buy-in to cover the short position. This directly addresses the regulatory requirement to deliver securities by the settlement date and mitigates further losses. FINRA Rule 11,820 mandates that firms must buy in securities that have failed to be delivered by the settlement date, unless an extension is granted. This proactive measure ensures compliance and minimizes financial exposure. Incorrect approach is analysis. One incorrect approach is to delay the buy-in, hoping the short seller will deliver. This violates FINRA Rule 11,820, which requires prompt action to cover fails. Such a delay exposes the firm to escalating market risk and potential losses if the security's price increases further. It also demonstrates a lack of diligence in managing the firm's obligations. Another incorrect approach is to absorb the loss without executing a buy-in, assuming the short interest is manageable. This is a serious regulatory failure. FINRA Rule 11,820 does not permit firms to simply ignore fails. A buy-in is mandatory to fulfill the delivery obligation. This approach also fails to account for the potential for the short interest to grow, exacerbating the problem. A third incorrect approach is to attempt to borrow the shares from another broker without initiating the buy-in process. While borrowing is a method to cover a short position, it does not absolve the firm of the obligation under Rule 11,820 if the original short seller fails to deliver. The buy-in process is the regulatory mechanism to address such failures and ensure market liquidity. Professional reasoning. Professionals should employ a systematic decision-making framework when faced with securities fails. This involves 1. Immediate identification and quantification of the fail. 2. Understanding the relevant regulatory requirements, e.g., FINRA Rule 11,820 for buy-ins. 3. Calculating potential financial implications, including buy-in costs and potential losses from market fluctuations. 4. Executing the required regulatory action, buy-in promptly. 5. Documenting all actions and communications. This structured approach ensures compliance, risk mitigation, and sound operational management.